Michael Burry, the man that predicted the 2008 financial crisis and the housing crisis, who they had Christian Bale play him in the film The Big Short, just revealed that he's betting against Nvidia and Palantir, the two biggest companies in the AI ecosystem. He bet 80% of his total net worth, over $1.1 billion, against those companies doing well in the next few months. Markets panicked when they found out that he'd done this trade. CNBC reported that it was one of the worst days on the stock market in recent history. Over $1 trillion was lost in a single day just because of this news. I'm Jack and this is In the Loop, and today we're going to discuss why Michael Burry did this, what he saw, and as a result we're going to follow the money. And in doing so explain why I think many people's reaction is just wrong. So, I think let's start with the circular financing that's going on right now. So if you know anything about Michael Burry and his housing trade, if you've watched The Big Short, you know he held these shorts. So which is, a short is when you bet against specific companies or a market, and if they do well, you lose your money. Now, he bet against all of these companies in 2008 for over 2 years. So between 2005 and 2007, everyone thought he was absolutely crazy because everyone was printing money. His investors, the people giving his company money, obviously were furious. And he held it regardless because he was 100% convicted in the problem that he saw and that was going to eventually explode. And as we all know, with the 2008 financial crisis, it really did explode. Now, here's the really interesting part about this particular bet against AI. By the time this information became public, Burry had already closed both his positions. So he was already out. He'd made his bet, he'd made his money, and had already got out. It was just a 3-month bet. It wasn't a 2-year bet like the housing crisis last time. So this is what sent me down a rabbit hole and why I wanted to do this episode on that topic, because I think the market reaction's been, well, you could argue ridiculous, but it's as a result of things that have been brewing for some time. Because $1 trillion lost in market value in basically a week last week speaks volumes. So I guess why did Burry pick these companies, Palantir and Nvidia? Well, first off, Palantir trades at 143 times revenue. So they are essentially being valued 143 times more than they make. That makes it the most expensive stock in the S&P 500. And it's more than double what peak 2021 SaaS companies were trading at during the bubble mania. And Nvidia is valued at 30 times sales, which makes the Palantir stock actually look reasonable in comparison. But when you dig into the SEC filings, you find something quite interesting and many people argue concerning, because 46% of Nvidia's revenue comes from just 4 companies, and all 4 of them are building their own chips to compete with Nvidia, which is obviously a bit of a red flag. And there's also a massive vendor financing issue, which I'll get into just now. So 85% of Nvidia's revenue is under vendor financing, which is basically when one vendor says, you will pay me this amount of money over this period, and they both kind of commit to that. So the money's not actually real yet. It's not landed in that company's bank account, but it will do over time. It's like the vendor, the person selling a good, financing others to purchase that good because everybody really wants it and will pay for it. And really, it's not a problem until the money isn't actually real in the ecosystem, and it's just numbers that are being thrown about. And this is where a lot of people have problems with the AI sector right now, because money is actually just going in big circles. So Nvidia agrees to invest $100 billion in OpenAI, which is great. And then OpenAI commits to spend that money on Nvidia chips over a certain period. Now, not all of the money, but a big chunk of it. AMD, another producer of chips and technology, commits to OpenAI buying $90 billion of AMD GPUs. And in exchange, AMD gives OpenAI warrants for 160 million shares of their company at a single penny each, which is basically giving away 10% of their entire company to OpenAI for purchasing these goods and services from them. OpenAI essentially pledged $300 billion over 5 years, which is $60 billion a year, and it's a non-binding agreement with a party that doesn't have the money to pay. So OpenAI can't afford that. Right? They don't have that money. And Microsoft wants OpenAI to commit and buy $250 billion of Azure services. So that's like their developer platform where they provide language models and other services. So they want them, OpenAI, to commit to $250 billion of those services over the next 6 years. And then Amazon just signed up OpenAI on AWS for $38 billion a year. One company's investment becomes another's guaranteed revenue. And it's all within a handful of maybe 20 companies that this money is just going in circles around. And so obviously Burry and other people are looking at this and going, that's potentially insane. Now I'll get onto my view on this shortly. But if you add up all the company's commitments and then work backwards, OpenAI's revenue would have to scale from $20 billion today to $577 billion by 2029. Just to support the commitments in spending they've given out. That's Google-sized revenue in 4 years. And Google took 20 years to get there. Right now, OpenAI lost last year $5 billion, and they made $3.7 billion in revenue. So they're burning $2.25 for every dollar they earn. And their infrastructure investments that they've committed to is $6 billion in 2025, then $50 billion in 2027, then $112 billion in 2028, and $173 billion in 2029. Now, that means they have to grow by 104% every single year, which is faster than Google ever grew. Google grew at about 70% every single year. And they were literally inventing digital advertising and modern day technology platforms at the same time. And I guess this is what Burry probably saw. Lots of circular financing with math that doesn't really work out. And now maybe it's a stretch, because maybe Burry also looked at historical parallels where maybe this hasn't worked out. We've seen this pattern before. So in 1999 to 2000, a company called Lucent Technologies basically had $8.1 billion in vendor financing out there, which was 20% of their revenue. They reported $41 billion in revenue to investors and to the world because technically, because of that vendor financing, them agreeing with other companies that those companies will send them the money, that they had $41 billion in revenue as a result. But they only actually had $304 million in revenue, actual cash coming in. So when the telecom industry back then collapsed, obviously that company collapsed with it. The SEC ended up charging 10 members of their exec team with fraud for manipulating essentially billions of dollars in revenue. And to put that into context for Nvidia, Nvidia's exposure is 85% of revenue. So 85% of revenue is potential vendor financing. So that's 4 times more than that Lucent Technologies that obviously collapsed when the telecom industry collapsed. So obviously that's the mechanics that Burry saw in the market. It's what people call a bubble. People say it's all going to collapse. Dangers with circular financing. But here's what I think people get wrong. So everyone's obviously freaking out that this is like 2008 and it's following very similar patterns as 2008 and the dot-com bubble. And everyone's going to lose all their money. And I think there's elements of truth in that. I'm not saying that there's no comparison and parallels here. There is a lot of danger in everyone getting very excited and committing a lot of money, and including individual investors as well as big institutional investors. But I think they are overall a little bit wrong, because there is big differences between now and then. The tech companies building this AI infrastructure aren't startups other than OpenAI. OpenAI, if it doesn't work out, is going to cause a big ripple effect. Let's put it that way. Because they've committed so much money to so many different vendors who have used that commitment to fund other things. But anyway, the companies that are predominantly funding this, the Microsofts, the Amazons, the Googles, are sitting on $500 billion in cash reserves. And they generated over $340 billion in this past year. So to put that into context, that Lucent Technology that collapsed because they were financing out too much, well, they had nowhere else to go. They were only serving telecom customers who, when the telecom companies collapsed, that company collapsed as a result. Whereas the companies we're talking about, the Googles, the Microsofts, the Amazons, their revenue is highly diversified. And Microsoft Azure is already making $86 billion in ARR from their AI services. Google has a search advertising platform that basically just prints money. And AWS is not reliant on AI to grow, although it needs to offer competitive services to grow in the AI space. It doesn't rely on AI to be successful and grow revenues. So although OpenAI is a critical factor in potential ripple effects that are going to cause absolute mayhem if they do collapse, nobody's completely reliant on OpenAI's commitments. And the same with the dot-com bubble era. I know I've said this before, and I'm not going to spend too much time on it as a result, but many of these companies were unprofitable startups with no path to revenue, and they were all investing in infrastructure they couldn't afford but weren't making any money and were relying on investors to pay for. This is different. And if you tried to take, say, Claude Code away or other services or AI platforms away from people, I think they would flip the desk. I wouldn't be able to cope. So yes, the vendor financing to OpenAI creates a lot of risk and exposure. Yes, if OpenAI collapses, someone is going to lose a lot of money and take a lot of write-downs. But a write-down isn't bankruptcy. It's not this systemic crisis that the Magic 7 are going to collapse all of a sudden, so the Facebooks, the Metas, the Googles. It's just going to delay AI rollouts probably for a few years. It's not going to stop anything. And I think that's why Burry exited his position after 3 months instead of trying to hold on to that for years like he did with the housing crisis. With housing, he saw the systemic crisis, over-leveraged banks, fraudulent mortgages, a financial system that would completely collapse if that domino fell. And I think he thought that that was worth holding out throughout the pain. But with AI, all he's probably seeing is an overvaluation of major companies in the market, too much expectation, and as a result would expect the share price of all those companies and the valuations of them to come down a bit. So yeah, to conclude, what does this all mean? Well, what I think is actually happening is that Burry invested against the mechanics of the market right now. That circular financing is real. The maths definitely doesn't work out fully right now, but OpenAI is betting big that if it goes to an IPO, it's going to raise a lot of money and people all want to get and buy in. I think that's probably true. And I think the panic about the market is, as always, a bit of an overreaction. But I do think that all these companies, like the Nvidias, the others, are well overvalued. I'm an individual investor for many of these companies, and they are so expensive right now. Their valuations compared to how much they're actually making is ridiculous. And everyone wants to get on the train because they see how much money is being invested. But everyone's a bit worried because it feels too good to be true. So there will be lots of these drops over the next coming period. I don't think it impacts how much value AI is actually delivering week to week. So if people are raising this, I guess, question of a bubble or a future market collapse, I hope you use this episode as a guide to have a good conversation about it. Anyway, I hope you enjoyed that episode. I certainly did. It was a really interesting one. I promise next week we'll probably get away from bubble conversations into an extra interesting topic. But anyway, I'll see you next week.